this course, I'll be showing you how to set up your indicators on the chart using Vwap. Also, how to read candlesticks, how to draw support, resistance, and trend lines, how to identify chart patterns, finding trigger entry points, and also things that I look for when making an entry or exit out of a contract. Here's a list of indicators that I use on my chart: volume, moving averages, Vwap, MACD, and RSI. Okay, so volume is the measure of how much interest there is in a particular stock. And volume is generated from people buying and selling the stock back and forth. If people aren't buying the stock back and forth, that's because they don't really have an interest in that particular stock. That's going to show up on the chart as an indicator, and it's going to tell you there's not much interest in that stock. And it's hard to make money when there's not much interest. I mean, you can always buy the stock, but remember, when it comes time to sell, you need to make sure that there's going to be somebody actually there to buy from you. So that's why you want to make sure the volume is there. A moving average is a technical indicator or a tool that tracks a security's price over a time period and plots it on the line. Moving averages smooth the price data to form a trend-following indicator. They do not predict price direction, but rather define the current direction with a lag. Moving averages lag because they are based on past prices. Despite this lag, moving averages help smooth price action and filter out the noise. Moving averages can be used to identify direction of a trend or define potential support and resistance levels. Exponential moving averages reduce the lag by applying more weight to recent prices. The weight that is applied to most recent prices depends on the number of periods in the moving average. Now let's see how we interpret this indicator and how we use it for trading. When working with this indicator, it's better to skip the opening of the market where the Vwap line is not smooth yet and moves very closely to the price movement. Where in the opening hours of the market, the price is crazy because of the very high trading volume, overnight news, and fundamentals. A signal that we can get from Vwap is Vwap breakout. Usually when the price goes above the Vwap line, it means that the bulls were strong enough and managed to push the price higher than the average value. So when the price breaks above the Vwap line, as you see right here, that can indicate a buy signal or a signal to open up a long position. And as long as the price remains above the Vwap line, we can say that the buying pressure is higher than the selling pressure and the market investors are buying above the average price of the day. And when the price goes below, like right here, below Vwap, it indicates that the bears were strong enough and managed to drive the price lower than the average value. So when the price breaks below the Vwap line, it's a sell signal or a signal for opening a short position. As long as the price remains below the Vwap line, it shows that selling pressure is higher than the buying pressure because the investors are selling below the average price of the day. MACD is based on moving averages, so generally it's a trend following indicator. But besides being a trend following indicator, it's also a momentum oscillator, which means that it gives us the ability to measure the momentum. So down here you have your MACD indicator. Your orange line is your MACD line. The blue line is your signal line. And these bars are your MACD histogram, which is used to forecast signals on the MACD. Then you have an imaginary line that runs through your histogram that we call the center line. When the height of the bars are increasing, or in other words, the positive values are rising, it means that the MACD line is diverging further from the signal line. And when the bars are becoming smaller, or in other words, the positive values are decreasing, it means that the MACD line is converging to the signal line. Center line crossovers can give you a signal on possible changes in direction of the market. When the MACD line crosses below the center line and turns negative, it is called a bearish center crossover. So right here on the chart, the MACD line crosses below the center line, which gives us a signal on possibility of changing in the direction of the market and turning to a downtrend. As you can see, the price declines after that. When the MACD line crosses above the center line and turns positive, it's called a bullish center crossover. And here, the MACD line crosses above the center line, which gives us possibility of reversal and changing to an uptrend. As you can see, the price is advancing after that. Only use MACD in an uptrend or a downtrend. Do not use it if the stock is trading sideways. So down here we have our RSI indicator and what it looks like. RSI is a momentum oscillator that is like any other oscillator. It moves above and below a center line and is on a scale from 0 to 100. RSI is used to identify overbought and oversold condition, and it is considered overbought when it is higher than 70 and oversold when it is lower than 30. So you have your 70 marked right there, and you have your 30 marked right there. Your center line would be 50. That runs all the way through. As you can see, the RSI shows some overbought right here, and also some oversold conditions, which gives a possibility of reversal and turning the price movement. And as you can see how the price changes direction after that. Okay, so now we're going to be going over on how to set up some indicators on this chart. First thing I want to do is change the theme. I want to come over here to the left, go down to settings, select dark theme, exit out, and boom, much easier on the eyes. Second thing I want to do is change this line chart into a candle chart. So we're going to come up here to line style, select that, then go down to candle and select candle. Boom. Okay, now we want to start setting up some indicators on this chart. As I mentioned before, our volume indicator is already a default down below. So to set up some other indicators, we want to come up here to indicators, select that, go to all indicators, select EMA, select MA, scroll down a bit, select Vwap, scroll down some more, select MACD, scroll down some more, and RSI. Okay, now we selected our indicators. We're going to come over here and edit a few indicators. So we're going to hit edit indicators, go over here to the left and select EMA. So the EMAs we'll be using is the 8 and the 21. So you want to change this 10 to 8, change the 20 to 21. Want to come over here to style, and since we're only going to be using the 8 and the 21, we want to uncheck this and select EMA 8 and EMA 21. Alright, now we're going to change some colors. We want to change our 8 to purple. I'm going to change our 21 to orange. Okay, we got that. Now we're going to come back over here to the left and select MA. Select inputs. And as far as the MA, we'll be using the 20, the 50, and the 200. So we already have 20 here. Want to change this 60 to 50. Change 120 to 200. Come back up here to style. Gonna uncheck that. I'm gonna select 20 50 and 200. I'm going to change our 20 to blue. I'm going to change our 50 to red. I'm going to change our 200. Wait a minute, let me pull this up a little bit. I'm going to change our 200 to lime green. Okay. Then we'll come back over here to the left side, scroll down a bit. Select Vwap. I'm going to change our Vwap to white. Okay, we got that done. Select done. Boom. Now we have our indicators on the chart. We have our EMA and MAs, as you can see, color coded. This right here is your MACD indicator, and down below right here is your RSI indicator. So there are three important things that every candlestick tells us. The first one is, where did the stop price open? Second, where did the stop price close? And third, what was the price action throughout that day? Candlesticks have two parts. First, you have the body, and the body of the candle represents the price range between the open and close of that trading's time frame. For example, if you're on the 1 minute time frame, each candlestick represents 1 minute. If you're on the 5 minute time frame, each candlestick represents 5 minutes, and so on. Then you have the wicks, which are long thin lines above and below the body. These reveal the intraday high and low. As you can see, there's a red candle and a green candle. Both represents different things. When the candle is red, it means that the closing price was less than the opening price, which indicates a price decrease. And when the candle is green, that means that the closing price was higher than the opening price, which indicates a price increase. In other words, on the green candle, you can see where the price opened and where it closed. In the example, let's say the price opened at 200 and closed at 250. Now during the day, the price got hit a high of the day of 275, which is represented by the top wick. And during the day, the price got hit a low of the day at 175, which is represented by the bottom wick. And it's the total opposite for the red candle. So on the red candle, you can see where the price opened and where it closed. In the example shown, let's say the price is opened at 250 and closed at 200. Now during the day, the price got hit a high of the day at 275, which is represented by the top wick, or during the day the price got hit a low of the day at 175, which is represented by the bottom wick. If the open was the highest price, then there would be no upper wick, and if the close was the lowest price, there would be no lower wick. Now we'll be going over a few tools and information that you'll be using when charting. First, we have our drawing icon up here. We can select that. And then when you're drawing your trend lines, you select trend line. When you're drawing your support and resistance lines, you'll select horizontal lines. Next, we have our time intervals up here. Got your 1 minute and your 5 minute, 30 minute. You can select whatever you want. Next, we have this area over here. You can slide this up and down, adjusting the height of your candles just by clicking and holding on your left click button on your mouse and sliding up and down. You can also do the same to slide the screen back and forth, up and down. And to zoom in, you have your plus and minus to zoom in and out, or you can use your mouse, the scroll bar on your ball on your mouse to zoom in and out. And last, we have this information box up here, and as you scroll across each candle, you'll see that it tells you different information on that particular candle. So up here we have our O, which means open, and that tells you what price did the candle open at. Then we have your H, which tells you the high of the day of that particular candle. We have your L, which tells you the low of the day of that particular candle. Then you have your C, which tells you that the candle closed at that certain price. And it also tells you what price your moving averages are around here, and your Vwap under each particular candle. Support occurs when a downtrend is expected to pause due to concentration of demand. As the price of the stock drops, demand for the shares increase, forming the support line. To find support levels, look for multiple reversal zones where the stock bounces back up. Also, moving averages can be used as support. Resistance occurs when an uptrend is expected to pause due to concentration of supply. Resistance zones arise due to selling interest when prices have increased. To find resistance levels, look for multiple rejections. Moving averages can also be used as resistance levels. When we put it all together, as you can see in this example, this chart shows a constant level of support, which is the blue line, that prevents the stock from moving lower, and a constant level of resistance, which is the orange line, that prevents the stock from moving higher. In charting, the more times the level is touched, the more significant the level becomes. However, this is a double-edged. If a resistance or support zone is touched or penetrated several times, it becomes more likely that a breakout could be coming. At the same time, however, the more times that a resistance or support zone is touched, the larger the decline is likely to be if the market falls instead of. Also note that when you have a breakout to the upside of a resistance zone, the price action tends to come back down to retest that resistance zone. If it doesn't fail at the retest and the price action continues upward, your previous resistance will now become your support, and vice versa for a breakout to the downside of a support zone. When you have a breakout to the downside of a support zone, the price action tends to go back up and retest that support zone. If it gets rejected at the retest and the price action continues downward, your previous support would now become your resistance. There are three different types of trends. First, you have an uptrend, where the overall trend of the market is upward. Then you have a sideways trend, where the market trend is ranging below resistance and above support. Last, you have a downtrend, where the overall trend of the market is downward. An uptrend is when the market makes higher highs and higher lows. Taking a look at this example, when drawing trend lines on an uptrend, you connect major lows identifying support creating at higher levels. In a downtrend, the market makes lower highs and lower lows. Taking a look at this example, when drawing trend lines on a downtrend, you connect major highs identifying resistance, creating at lower levels. In a sideways trend, the market is ranging from support to resistance and from resistance back to support. When drawing trend lines, you need at least 2 points in the market to start a trend line. Once the high or the low pivot point has been identified, you can draw your trend line. Most trend lines you come across will have some overlap from the high or the low of the candle. But what's important is getting the most touches possible without cutting through the body of the candle. Never try to force a trend line to fit. If it doesn't fit your chart, then it isn't valid. Charting refers to technical analysis that is performed through careful inspection of share price data for identification of well-known patterns that emerge in share prices. For example, head and shoulders, channels, triangles, wedges, and so on. Pattern formations do not form a trading system, but rather provide an indication of future trends of a share as the price breaks key barriers in the form of support and resistance lines. Let's look at a few examples using chart patterns. Here you can see the daily trend lines form the falling wedge and the price action after the falling wedge breakout. And here you see a bullish pendant breakout and the price action after the breakout of the bullish pendant. In this example, you can see an ascending triangle, which is formed by the daily trend line in yellow and the daily resistance line in orange. Then you will also see the result of the price action after the breakout. After drawing your support, resistance, and trend lines, now you can find your triggers, which are your entry points. Let's take a look at the previous chart patterns that were shown. In this example, let's pretend all the price action above this orange resistance line hasn't occurred yet. So let's try to find our trigger points. First thing you need to know is your crosshairs. Crosshairs are these vertical and horizontal lines that you see as you move your mouse from left to right, up and down. Now let's say this day right here represents Thursday, and we're trying to find our trigger entry points for Friday. So the first thing you want to do is put your cursor on top of Thursday's candle, move it slightly to the right, and you'll see your crosshairs jump to where Friday's candle will be established. Now let's try to find our put trigger. You'll come down right below the daily trend line. You can look to the right, and that would be your trigger entry price. And for calls, you will put your cursor right above the orange resistance line, look to the right, and that price would be your trigger entry price. So you will get your trigger entry points from below and above each particular chart pattern. Okay, let's go through a few examples on using our charting techniques to find option picks. So we got waste management here. So the first thing we're going to do is get our support and resistance. Alright, so support, we'll take the bottom of this pivot right here and just place a line there. We're going to put our support at blue. And we could just drag this up where we see a good line of support right there by that pivot, and then you could just scroll across and see where, if that's actually a good support. And you have support there, you have support here, and you have support there. That's a pretty good support spot. Alright, let's find resistance. Resistance, I'm gonna make orange. Oops. So resistance, we're gonna make orange. Got that orange. Okay. I'm gonna put resistance at the last trading day's candle. Put it right at the top. Then you could just run across it and make sure that's a good resistance. It usually is. Yep. Everything looks good. Got resistance from the day, current day. Got resistance right here, right here. Got resistance right here. Okay, good. That's good. Resistance line. Now we can find our trend lines or draw our trend lines. Go up here, go to trend line. And we're going to take it at the bottom of the pivot. And draw our trend. Try not to cut in any candles. Okay. We're gonna make our trend line yellow. And also get our top trend. That's a high pivot. that all the way across. So you have a touch here, 2 touches there, and a touch right here. So now you have your top and bottom trend, which formed your triangle pattern. So after you have your pattern identified, you can find your trigger. So finding the trigger, remember you put your mouse over your last trading day candle, slide it to the right a little bit, and it'll tell you where that next day's candle will be established. So we can find our call trigger right above our trend line. But in this case, since the resistance line is running straight through our pattern, we can actually just have our call trigger at above resistance. So we'll put the line, we'll put our mouse right over the resistance line and get our crosshair just above the line. So our call trigger would be 165.53, and you can give it a little cushion. So I would say about 165.60 or 165.65. And then to find our put trigger, well, in this case, you can play it off. You can play it off 2 ways. Let's get to the next day's candle, and then so you can actually play it off the rejection of this top trend. So that would be your entry point for a put would be around 164.83, and then you can actually ride that down if it decides to go down to the bottom, well, to the top of the bottom trend line. So that would be 163.42. Remember, your trend lines act as resistance and support also. So you can get in around, have your support at 163.42. Or in another scenario, you could just get your put trigger right outside the triangle, which would be 162.48. Okay, so in this example, we would have Home Depot. All right, go ahead and get our support line at the bottom of this pivot. Just place it there. We're gonna support is blue. So you see we got support right there, but it actually runs all the way through and it's cutting through. We could bring that support down a little bit more, right under where this candle opened at. So you have support there and you still have support there, as both of them are touching that line, that support line. All right, let's find our resistance line. Put it right at the top of the last trading day's candle. Resistance, we're gonna make orange. Okay. So we have resistance there. We have some touches up here. We have resistance right here. So that's a good resistance point or zone. Okay, so now we can get our trend line. Bottom of the pivot. Find our trend. Try not to cut in any candles. You can cut into the wicks, but try not to cut into the candles. So boom. Gonna make our trend lines yellow. We can also get a top trend line. Okay, so we have another triangle here. With this triangle, play it the same way. Put it on last trading day's candle. Move to the right a little bit, see where the next day's trading candle will be established. Go above our trend line to get our call trigger, which would be 408.87. We'll go below the trend line of the bottom trend line to get our put trigger, which would be 401.69. Okay, now let's take a look at Dole. Okay, so first we're going to get our support line, the bottom of this support, make blue. So we have good support right here. We could probably bring that down just a tad bit to get some support around in this area. So get just below that candle right there where it opened at. So we have support right here, we have support right there, we have support right there, support right here. Okay, now let's get our resistance line. Put it right above the last day's trading candle. Make our resistance orange. Okay, make sure our resistance is pretty good. Resistance all in this zone right here. Got resistance right here and resistance in this zone. So that's pretty good resistance line there. Okay, now we can start drawing our trend lines. I'm gonna take that bottom pivot, run it up towards the trend. Try not to cut in any candles. The trend lines are yellow. Get our top trend line. Run that straight down, not cutting in any candles. Boom. We can shorten this up a little bit, just make it look a little cleaner. Alright, so there you have a pendant. And you can actually look for a breakout above this pendant as before. So that this one would be your call trigger would be 13.15. And your put trigger would be 12.95. But with something this close and tight, you might as well just play the break of below support and a break above resistance. And also you're running this a couple times that let's get rid of our trend lines. Well, we'll get rid of that top trend line. And sometimes you'll find more than one chart pattern within the chart. So we can take it at the bottom of this pivot and run that straight down. Try not to cut in any candles, run off the trend. And boom, you got a falling wedge. So you can play the falling wedge breakout also. But like I said, in this case, you'll just play the break of resistance and the break of support. Okay, in this last example, we're going to work with PayPal. So as before, we're going to get our support line, bottom of this pivot. Support is blue. So we got good support in that area. A little good support. We could probably try to bring this support up just to get some touches in this zone right here. Let's see what happens. So yeah, that's even better. So we have a support zone all right here in these three candles. We got that one touching. We also got a support zone right here as of these wicks are touching support. So that's pretty good support. Now we can find our resistance. Put the line at the top of the last trading day's candle. Resistance is orange. Make sure we got a good resistance. We got a good resistance zone right there. We got one right there. Pretty good resistance. We got some right here. Just broke through right here, but don't mind that as long as we got more than, I'm not even gonna say more than, just a good amount of touches for our resistance. Okay, so now we got our support and resistance. I'm gonna go ahead and identify a pattern. So we'll get our trend lines. Now we can get our bottom trend line going. Let's see, we'll take it from this bottom pivot and just run it all the way across. Okay, and our trend lines will be yellow. And then we could take a top trend line from this pivot and run it with some touches. Try not to cut into any candles. Boom. Looks good to me. Okay. So out of that, let's make this a little bit bigger. So out of that, what we're working with is a channel. That's a channel pattern, excuse me. So to get your trigger points, you already know. Last trading day's candle. Move to the right to see where the next candle will be established. And you can find your trigger above this trend line, which would be 192.86. You can play it as 192.90. Give yourself a little cushion, or even 192.95. Or just like, I believe it was Home Depot, or maybe Waste Management. Yeah, it was the Waste Management example. We could play it off this bottom of the top trend line as far as a rejection. If this wants to continue going up, down, up, down, up, it might come back down. So you could play it with that trigger at the rejection of this bottom trend line, which would be 192.21. Or you can play it under the trend line, which would be under the bottom trend line, excuse me, which would be 183.22. But if you're going to play that, you might as well play it under support, which is 182.56. Okay, so we're gonna go over how to make an entry if you was getting into a call. So the first thing you want to look at is your volume. Then you want to make sure the stock is trading above the AEMA, which is your purple line. Then you also want to look at your MACD indicator to see if it's having bullish or bearish tendencies. And you also want to look at your RSI indicator to see if it's oversold or overbought. And you can also look for entries with the AEMA 21 EMA cross. So when the AEMA crosses above the 21 EMA, that could be a good indicator for an entry. As you see right here, the AEMA is below the 21 EMA, and as it crosses above, the price action starts to go up. So you could have rode the stock from around 340 all the way up to 344, 345, and you can keep riding the option if it stays above the AEMA. So your exit point would be when it breaks the AEMA. So right here, you would have been at an exit point. Don't worry about what's going on afterwards, because you never know. Just make sure you exit at that point when it breaks that AEMA. And remember, all this is on the 5-minute chart when it comes to breaking the AEMA or crossing the 21 EMA.
And so we can go over doing a put if you was getting an entry in a put. So we can take a look at Microsoft. So things you want to look at is make sure that the stock is trading below the AEMA, your purple line. And you also want to check your MACD to see if it's having bullish or bearish tendencies. Also your RSI to see if it's oversold or overbought. And then you could do the complete opposite, whereas you was doing on the call. So for the put, the entry on the put, you'll look at the AEMA cross below the 21 EMA. So like right here you have the AEMA crossing right below the 21 EMA. That would have been a good entry point for your put. Then you could have rolled the stock all the way down as long as it stayed below the AEMA. Once it gets above the AEMA, that will be your exit point. As you see right here, it starts to reverse. And it closed above the AEMA, so you would have got out right here. Otherwise, you would have just got burnt.
Okay, let's go over some candlestick patterns. We'll do this bullish side first, and we'll start with the hammer. Now the hammer is one of the easiest patterns to recognize. This pattern is made up of a candlestick with a long lower wick at the bottom of a downtrend. The body is usually small with a little to no upper wick. A hammer may either be red or green. It may indicate a strong reversal trend and a potential price surge. This pattern shows high selling pressure. However, during the same period, the buying pressure retook the control of the price action. Okay, let's move on to inverted hammer. And the only difference between the inverted hammer and the regular hammer is the long wick above the body rather than below. An inverted hammer may either be red or green. An inverted hammer indicates the potential beginning of an uptrend, with the ended downtrend indicating buyers might soon gain control. Now we can move on to Morning Star. Morning Star is a pattern made up of 3 different candles in a downtrend. The first is a long bearish candle. The second, the star, presents very long wicks, a short body, and closes below the previous closing price. The third candle is a long bullish candle that closes above the midpoint of the first. The star signals that the current trend is losing steam, often confirmed with the third candle launching an uptrend. Move on to bullish engulfing. This pattern is made up of 2 candlesticks occurring at the bottom of a downtrend. The first one is bearish, which is red, while the second is green and engulfs the other. In other words, the second candle's body is bigger than the previous. There should be a gap between the closing and opening price. Then you have piercing line. Piercing line is a pattern made up of a long red candle followed by a long green candle occurring at the bottom of a downtrend. There's a gap down between the closing and opening prices, with the closing of the green candle more than halfway up the red candle's body. The beginning of the period looks very bearish. However, the buying pressure increases throughout the candle, indicating the bulls are interested in buying at a current price. Then we got our 3 white soldiers. 3 white soldiers is a pattern that consists of 3 green candlesticks inside of a downtrend. The second and third candle open within the body of the previous ones and close above it. The candles usually have little to no lower wick. This pattern indicates a strong buying pressure which drives the price up and even indicates an upcoming price reversal. The bigger the candles are, the stronger the pressure is. Alright, so now we can move on to the bearish side and we'll start with shooting star. And shooting star is made up of 1 candlestick with a small body and a lower wick. The upper wick is very long. Unlike very similar inverted hammer, this pattern occurs at the top of an uptrend. This pattern indicates a strong price rejection after a significant push-up. The shooting star is often associated with a signal of a bearish reversal. Next we have the hangman. The hangman is a bearish equivalent of a hammer. It's usually formed at the end of an uptrend with a small body and a long lower wick. It can either be green or red. This pattern signals the weakness of an uptrend, and traders often associate it with a sell signal. Next we have an evening star. The evening star is the exact opposite of a morning star. It is made up of 3 different candles in an uptrend. The first is a long bullish candle. The following candle, the star, presents a long wick and a short body. The third candle is a long bearish candle that closes below the midpoint of the first candle. The star signals that the current trend is losing strength, and traders may use it to sell positions. The confirmation occurs when the third candle, which often launches a downtrend. Next we have bearish engulfing. This pattern is made up of 2 candlesticks. The first one is green while the second one is red and engulfs the other. In other words, the second candle's body is bigger than the first one. This pattern indicates an increased selling pressure and the beginning of a potential downtrend. Then we have dark cloud cover. The dark cloud cover pattern is made up of a red candle that opens above the closing price of a previous green candle, but then closes below the midpoint of that candle. This pattern appearing in an uptrend generally creates a new high. This pattern can indicate 2 things: a pullback or at least the ending of a current uptrend. In both scenarios, traders tend to read this pattern as a sell signal. And last we have our 3 black crows. The 3 black crows pattern is recognizable by 3 red candlesticks inside of an uptrend. The second and third candle open within the body of the previous ones and close below it. The candles usually have little to no lower wick. This pattern indicates a strong selling pressure which drives the price down and can announce an upcoming price reversal. Also note that you can use these candlestick patterns in any time frame. Well, that's the end of the course, and I'm almost 100% sure that all the information and tools I've given you will make you a way better trader.